Good morning. Let's look at three important themes in global business today and try to draw some conclusions. The first is this one. Exports from China are hitting records. Despite the trade wars and the high tariffs, Chinese exports are booming. These data are from August, up 8.7% year over year. This is the fifth month in a row that's seen Chinese export growth, and it totaled $308 billion for the month, which was the strongest in 18 months. China's exports are also hitting records in the United States. Companies and consumers in the US and Europe know about the high tariffs they have to pay, and they're placing record high order volumes from Chinese factories anyway. Here is the second issue. Chinese manufacturers who have set up operations in Vietnam are having second thoughts. They established final assembly plants in Vietnam specifically to avoid US tariffs, but they're losing control of costs. The South China Morning Post profiled some Chinese companies and looked at a tools manufacturer. 2/3 of their business comes from the US market, and they set up in Vietnam to get around the US tariffs. But they're making a lot less money than they thought. Costs are 7% higher in Vietnam compared to China, which means they were better off staying in China and just telling their buyers to pay the tariffs. The supply chain in Vietnam is slower compared to China. Vietnam is a hodgepodge of rules and policies that are difficult to navigate. It goes on. Inflation is high in Vietnam, whereas in China, inflation basically doesn't exist. Vietnam does not enjoy the depth of China's raw materials and processing supply chains, or even labor. But in order to set up there, companies need to invest tens of millions of dollars. Then they've got to recruit and train local employees, and those costs are all going up, and quickly. Land costs are also going up. In the north part of the country, rents are doubling every 10 years and every 6 years in South Vietnam. This is macroeconomic event number 3. European manufacturers, particularly those from Germany, are closing factories and plants in their domestic markets while expanding production here in China. Volkswagen is canceling labor agreements with unions in Germany, which will lead to layoffs at 6 German plants. These factory closures will be the first in Volkswagen's history. But at the same time, VW is investing nearly $3 billion to expand production in Anhui province and deepening their partnerships with Xiaopeng Motors to develop new models here. Euronews reports that the problems at German car makers are happening elsewhere in manufacturing. BASF is a huge chemical company, which is also closing factories in Germany and building up production in China. They're cutting €1 billion in Europe to invest €10 billion in their plants in southern China. BMW is also doubling down on their China operations, putting in an additional $2.8 billion into their factory in Shenyang in Liaoning province. To date, their investments in Shenyang alone total $15 billion or so. And they'll be building a new class of cars, as well as the latest generation batteries for electric vehicles. Given those three realities, what are managers of global manufacturing companies thinking, and what are they doing? They have concluded that the only way to access China's supply chains is to be in China. And if they have access to Chinese supply chains and logistics, they should simply ignore the tariffs, whatever they are. Now, Vietnam. Vietnam is right next door. Vietnam and China are very friendly countries. Yet the Chinese companies that are operating there are complaining that they were better off had they just stayed in China rather than try to get around the tariffs by setting up in a developing economy where the costs are all shooting up. And they complain that even though they're just right over there, they're still too far removed from the deep supply chains and the labor pools and the policy protections that mainland China gives them. What all this means is that Chinese companies probably are not going to be doing much more capital investment abroad. If they're having a tough time in Vietnam, it's much less likely that they'll consider capital investment in India, for example. Imagine a company like BYD or Xiaopeng or NIO. These are major Chinese car brands who need to hire thousands of people. Setting up in Vietnam would just make an already bad situation there much worse. And if they're looking at India or East Europe, which on paper may confer a lot of advantages on avoiding tariffs, and on paper also offers a lot of low-cost labor, they would first ask, why isn't VW or BMW or BASF setting up in those countries? Our high tariffs do not matter. Cheap labor in developing countries, they don't matter. The supply chains do. And this is where the supply chains are. European companies are closing plants there and expanding them here. So we should not expect Chinese manufacturers to go the other direction. This is Qinghai. Be good.
Love the Lord your God with all your heart, with all your soul, with all your mind.